So professional services starts, continues, and ends with ethics in mind. As you know, the Georgian law requirement to comply with ethics code is very strict and of the highest priority. So accordingly, our professional organizations who provide CPD courses each and every year include this topic on constant basis. And today is a unique opportunity and privilege for all of us to have key speakers on this topic from the global perspective. The chairman of the IFAC, International Ethics Standards Board for Accountants, Mr. Stavros Tomadakis. It's a big honor, Mr. Tomadakis, to welcome you. And Senior Technical Director of IESBA, Mr. Ken Seong. A big pleasure. So we are glad that our event became international, and we have participants from Georgian profession, also our colleagues from startup countries, Eastern Partnership countries, oversight bodies, and practitioners. Again, many thanks to Twinning Project and personally to Panos Giannopoulos, the project leader of Twinning, and deputy chairman of Greek oversight body who makes this possible. So as it was mentioned by Dimitra, please write your questions during the presentation at Q&A section. So Panos, the floor is yours, please.
Thank you, Yuri. Ladies and gentlemen, good afternoon for me. First of all, I would like you to send my wishes to you and your family. I hope you all keep well and safe in this unprecedented situation of the pandemic COVID-19. It's a pleasure and honor for me to be here with you under the EU Twinning program, which is coming to an end, and this is high in the agenda at today's event. So today's event is to presenting an overview of IESBA and the IESBA Code of Ethics, which aims to establish a conceptual framework for all professional accounts to ensure compliance with fundamental principles of ethics. This event was organized first from Yuri and my initiative because we strongly believe that that this will add value to the program. This will add value to the participants since, as you will see, there is a lot of initiatives at the level of IESBA that are taking place right now. I will stop here. I would like to welcome our distinguished speakers with a vast experience on auditing, accounting, and corporate issues. A few of many roles that Dr. Stavros Tomadakis has is that he's the chairman of International Ethics Standard Board for Accounts. He was also chairman of the Hellenic Capital Market Commission, had chaired the IOSCO European Regional Committee, was the first chairman of the PAOB, the Public Interest Oversight Board, which oversees the activities of the IESBA and other standard centers, and was also a member of IESMA, the European Security Market Stakeholders Group. And also would like to present Ken Seong, is the technical director of IESBA. He managed and oversees the work of the IESBA and also play a key role in developing and strengthening the IESBA relationships with the shareholders, with the stakeholders. I will now give the floor to both of them to begin their presentation, which I personally look forward and hope you find today's meeting interesting and productive. So, Dr. Stavros, the floor is yours.
Thank you very much, Yuri, and thank you very much, Panos, for your kind words, the warm introduction, and the invitation. We consider this is a very valuable opportunity to see an international audience that you were so kind to invite to this session. I want to echo Panos by extending in advance my best wishes, because we're entering a holiday season now, and a holiday season at a difficult time with the coronavirus. So best wishes for health, quiet, and optimism for the future. I would like to start by saying that we will present briefly the organization, the board, the IESBA, and then, of course, most of our presentation will focus on the code. We will stop at certain points for questions. If there are questions at the time we stop, we'll be happy to answer them. If the questions come later at the second stop, we'll entertain them too. And in the end, any questions that we may not have time to ask, of course, we would welcome you to send them to us, and we'll try to answer those. Can we go to the next slide, please? Well, about ourselves, the International Ethics Standards Board for Accountants. We are, of course, an independent global standard setting board. We're not part of the International Federation of Accountants. We are supported by and offered an infrastructure by the Federation of Accountants. We're an independent global board formed in 2005. And our mission, as you see on our slide, is to serve the public interest by setting ethics standards, including, very importantly, auditor independence requirements. We seek to raise the standard, to raise the bar, to raise ethics in the conduct and practice of all professional accountants, not just auditors, all professional accountants. And of course, we're trying to do this on a global scale. So the code is a global code. It is designed and constructed to have application around the world. Therefore, it is, of course, a principles-based code. It doesn't include, except in a few instances, it doesn't include very specific rules. We think it is a matter for national jurisdictions to make up additional rules. As it happens in many cases, the standards, when we finalize them and publish them, are available to national standard setters, and then it is national standard setters, such as you have in your own jurisdictions and everywhere in the world, who make the decision to adopt the code or not. So we are standard setters. We are not adopters of the code, nor are we policing the implementation of the code. This is up to national authorities, just like the supervisory authorities who are present today and listening to us. The IESBA has 18 members, which are 50% practitioners, 9 practitioners, and 9 non-practitioners. And among the non-practitioners are at least 4 public members. The chair, myself, is an independent chair. I do not come from the accounting profession. I'm not a practitioner. I am one of the public members. And I will not say what my background is. Panos was kind enough to mention some of that. We have several official observers. The 2 more permanent ones are the Japanese, an observer from the Japanese Financial Services Agency, the regulator of the capital market in Japan, and of course, the chairman of our consultative advisory group. I'll talk about that in a moment. But among the members of the board, we are seeking, and we have great diversity, not only in experience and background and in perspective, but also in gender and in terms of geographic diversity. So at present, at the board, we have representatives from every part of the globe. As you see, Africa, Asia, Europe, North America, Oceania, South America. Our structures and our processes, especially our infrastructure, are facilitated by IFAC. That's why we don't call our code the IFAC code. We call our code the IESBA, the IESBA code, because we are independent and IFAC does not influence our agenda or our process of going about setting the standards. Now, the board works under public interest oversight. There is a public interest oversight body. I had the honor to be the first chair of that about 15 years back. The PIOB members are appointed by the monitoring group, which is a set of international regulatory organizations like the Basel Committee, the European Commission, Financial Stability Board, IFRR, IOSCO, WorldBank, the International Insurance Regulators Agency, and so forth. The PIOB, the basic function of the PIOB is to review the standards we put out and approve them as responsive to the public interest. We are also advised by a wide consultative advisory group, the CAG. Presently, our CAG has 22 member organizations and 3 official observer organizations. And again, you see some examples of the type of representation we have. These are not only from the regulatory space, but they are also from international organizations like the OECD and networks such as the Corporate Governance Network and so forth. So we get very wide participation and diversity in our consultative advisory group, and we discuss with them our standards, and part of our due process is to take into account and respond to points, questions, and advice from our consultative advisory group. Next, please. Of course, a lot of our energy and a lot of our effort, and for me personally as well, is in the engagement and collaboration with stakeholders. We have been active in strong stakeholder engagement and communications, close dialogue with international and national regulators, such as yourselves, but also with the broader organizations, IFRR, CAOB, IOSCO, the Basel Committee, and so forth. At the same time, we're focusing on strengthening our dialogue with the profession and the professions organization, the Forum of Firms, which includes the big international network firms, about 31 or 32 of them, the IFAC Small and Medium Practices Committee, the Advisory Councils for Professional Accountants in Business, and of course, professional accounting organizations who are the member bodies of the International Federation of Accountants. We are, of course, Ken, just a moment, let's go back for a moment. We are, of course, working very closely with our sister board, which is the International Audit and Assurance Standards Board, with national standard setters, with IFAC, Intosai, etc. So we have a very wide range of collaborations and engagement with stakeholders. Let's go on to the next, please, Ken. Now, in terms of global adoption of the code, where we are, first of all, you will know, of course, that in 2019, our new restructured and revised code became effective. Before that code had become effective, the extant version was 2016, I believe, and there were about 140 jurisdictions around the world that have and had adopted the earlier version of the code. As soon as we put out the restructured and revised code, we undertook a great deal of efforts to raise awareness and to encourage jurisdictions to adopt the new code, which has quite a few changes as compared to the old version. And I'm happy to say that as of now, there are 80 plus jurisdictions, among them the majority of the G20 countries, among them your own jurisdiction, Georgia, and several others of participants here who have adopted. So there is a lot of momentum in the adoption and the implementation of the restructured code, which we're very happy with, but we are also continuing knowing that there are still a number of jurisdictions that have to adopt. The restructured code has also been adopted by the large international network firms, 31 of them, what we call the Forum of Firms, for their transnational audits. And it has been translated in over 40 languages, including all major UN languages. So I think there is momentum in the adoption of the code. And this momentum, by the way, is not just because people think that it is good to adopt a more relevant and a wider version of the code. I think it is because we're living at a time when ethics is becoming of more and more central importance. And I want to echo what Yuri said in the beginning, that the ethics is very important in these days. And I will add that in days of crisis, such as the economic crisis we're going through now because of the COVID pandemic, bring ethics to central stage. So behind the adoption of the code, I think, is a global movement towards more ethics, more robust ethics, and a higher bar of ethical behavior in markets, in corporations, in companies, and in professions such as the accounting profession. So let me say one word about what you see. Along with putting out the restructured code, we have put out a very, very useful tool, which is in the form of an application. This is the E-code. This is the digital version of the restructured code, which literally you can import onto your telephone or your computer. But it's not just a digital version of the text. It has certain functionalities. It allows you to search words, concepts, titles, and so forth. It allows you to copy and paste and to collect various parts and put them together. It allows you to navigate the code. So you just see here a shot of how things are set in the code. As you know, as most of you will know, the code includes requirement paragraphs and application material. R's and A's are the signals of the two types. And of course, using the E-code, if you want to see just all the requirements, you can see all the requirements. Or if you're interested in, say, conflict of interest, you can see the conflict of interest right away and so forth. In addition, the E-code includes a lot of non-authoritative material we put out as we put out standards, such as basis of conclusions, staff answers, questions and answers, frequently asked questions, white papers, and so forth. So I would urge on all of you to check and import onto your devices the E-code, which we are very proud of. Well, time has come for me to stop and ask you to pose your questions. Yuri, if there are any questions ready, I can take them now. If they're not ready, I can wait for a minute and then continue. Up to you.
Yes, Stavros, so far we don't have any questions. I guess we can continue.
Okay. Okay, we can continue. And in that case, I would like to turn to my colleague, Ken, to take the floor for his part.
Thank you very much, Stavros, and I hope you can all hear me. I'll just spend a few moments to talk about the structure, the architecture of the revised and restructured code. So what you see here is basically an overview of the structure of the code itself. It's divided into 4 parts. At the top there, as you can see, it's part 1 that deals with basic principles about compliance with the code, basic requirements. In addition, we have in part 1 the fundamental principles that are set out, the 5 fundamental principles, and I'll come to that in a moment. And then we have the conceptual framework. Again, I'll speak to that in a moment. The conceptual framework is basically the code approach we take to address threats to compliance with those fundamental principles. Then we have part 2 of the code that deals with specific circumstances for professional accountants in business. Part 3 deals with professional accountants in public practice, those who are in accounting firms. And parts 4A and 4B deal with the independent standards. They contain the international independent standards for audits and review engagements, as well as for other assurance engagements. And at the end of the handbook, the code itself, we have the glossary of terms that contains all the definitions and descriptions of key terms in the code. So that is a broad overview, if you will, of how the code is put together. Part 1 contains the building blocks of the code, and the way we visualize the code is that it is architected on a building blocks structure, and those building blocks are in part 1 of the code. Part 2 and parts 2, 3, and 4A and 4B all depend on part 1, the essential elements of the building blocks. So we'll cover those building blocks here. As you can see, this kind of summarizes the conceptual underpinning of the code. We have the 5 fundamental principles that you can see in the blue boxes: integrity, objectivity, confidentiality, professional competency, due care, and professional behavior. In addition to that, accountants who perform audits and assurance engagements are required to be independent. So independence also features quite prominently within the basic architecture of the code. And the way the code approaches compliance with those fundamental principles and with independence requirements is to apply a conceptual framework. And I'll touch on that in a moment. What the code also does is, and as part of that conceptual framework, is to identify 5 categories of threats that can lead to breaches of those fundamental principles or breaches of independence. Those categories of threats you can see on the left-hand side. We have self-interest threat, a self-reveal threat, threat of familiarity, threat of intimidation, and threat of advocacy. So these are the 5 categories of threats, and these can arise in different circumstances depending on the particular situation the individual accountant or the firm is involved in. So what is a conceptual framework? In its most simple terms, it is a 3-step approach to deal with threats to compliance with those fundamental principles and where applicable independence. It contains those 3 steps. The first one is to identify the threats. These are threats that can arise from professional activities, interests, and relationships of either the professional accountant or the firm, depending on the circumstances. Once the threats are identified, then there's a requirement to evaluate the level of those threats, how significant are they, and finally to address the threats that are not at an acceptable level. And there are 3 ways to address those threats. Number 1, to eliminate the circumstances that create those threats. So whether it's elimination of the relationship or the interests that are giving rise to the threats, or not to be engaging in those professional activities that are creating the threats. Secondly, it's about applying safeguards. And safeguards are defining the code. There are actions that can be taken either individually or in combination to reduce the threats to an acceptable level. And the key provision in the definition of safeguard is that those actions must be effective in reducing the level of threats to an acceptable level. So it is an assessment that is necessary. The safeguards have to be effective. And the third way to address this threat is to decline or end a specific professional activity or service that is giving or might give rise to a threat. As part of the conceptual framework, it is required to apply the reasonable and informed third-party test. And that is a test which is, if you will, an objective assessment from the accountant's point of view, looking from outside, what would a reasonable and informed third think about how the accountant or the firm has addressed in terms of the actions they've taken to address a particular threat. And the code defines a reasonable and informed third party as essentially being a third party who must be objective, first of all, and secondly, have the appropriate knowledge and experience to evaluate the judgments and conclusions of the accountant or the firm. So, as you can see here, the graphic is quite self-contained. It's in the middle. It's the three steps, and in the outer circle, it's essentially the three key requirements within the conceptual framework. First of all, there's a requirement to apply appropriate professional judgment. Secondly, to remain alert for new information or changes in facts and circumstances that might create new threats or even change the level of threats. And thirdly, to use the reasonable and informed third party. So these are the essential elements of the conceptual framework. So let me pause here and see whether there are any questions, Yuri.
We have two questions. First is from Andre. In view of globalization, is there engagements or convergence of ethics codes?
I guess that's a question for me, Yuri, from the previous presentation, and the answer is yes, yes, yes. The IESBA itself, the existence of our board, the fact that we are a fully global board, and the adoption of the code by so many jurisdictions, I think is very robust empirical evidence that the various jurisdictions seek convergence to the basic ethics code, which is not just the fundamental principles, which are very important, of course, but it's a lot of specializations of the fundamental principles in the various areas of the code. We'll talk about some of them. So, especially encouraged by the recent wave of adoption of the restructured code in a relatively short time of 1 year, I would say that, yes, there is momentum towards international convergence. And let me say, by the way, that there are, of course, jurisdictions, say the EU or the United States, that have their own sets of specifications, especially for listed firms. A lot of these specifications, of course, abide by the same fundamental principles as the code. The difference between those specifications is that since they are in narrower jurisdictions on the globe, they include many more rules and rules-based elements in them. We are currently undergoing an exercise which is we call benchmarking, whereby we're trying to make comparisons of the restructured and revised code with all the current revisions, with the US SEC code, and our next step is going to be with the EU directives. And we're finding so far that there is a lot of overlap in those structures. But again, we believe that it is more wise from the perspective of a global strategy to work on a principles-based code and make that the benchmark for convergence instead of taking any national code, say the United States, and impose it on the rest of the world. Because there are differences across the world, and being principles-based is very important.
Thank you very much. Another question we have from David. What were the main findings and challenges for development and adopting restructured IESBA code?
Oh, that's a very good question, and I'm happy to say a few words about it. I would say that the restructured code the restructuring had two legs. One was a change in the structure, which Ken described before in the various parts of the code, and going to this building block approach, where we have some very fundamental building blocks and we built upon them, which makes the code easy to understand, easy to navigate, and easy to revise also, because you can revise certain items without disturbing other parts. Secondly, the restructuring took into very serious consideration the translatability and the simplicity of language and the clarity of the language of the code, because of course the code is written in English, and if you have a lot of Americanisms in there, translation, I'm Greek and I know the translation into Greek sometimes is not possible. So we have to draft keeping in mind that the code has to be translatable. That was a second thing. The third thing is that we did this separation between requirements and application material to help enforceability and to help application of the code. And for example, audit inspectors like some of yourselves can really now look at the requirements and see what are the parts of the code that need to be enforced. So that was one leg, the restructuring in language, in structure, in building blocks, and in distinction of requirements and application material. The other part, the other leg, was that there were some very substantive revisions. We will be talking about some of these revisions later in our slides, so I will not go over them, but we will talk some of the revisions that have taken place, and we will talk some of the revisions that we have been working on and just last week voted on and decided them, which we think are very forward-looking and make major steps in robust ethics standard setting for the world in our circumstances. But we shall be talking about those, and so I will not go into that.
Thank you very much. So far, we exhausted the questions. We can continue with the presentation.
Just a moment, Yuri. Sorry for the interruption. Ken, could you please speak a little bit closer to your microphone? Sometimes we cannot hear you very well. Thank you.
Okay, thank you.
Now it's good. Now it's better.
Okay.
Thank you.
Can you hear me all right, Dimitra?
Yes. Everything was well. At some point, it's okay. Thank you very much. Sorry for the interruption.
So let me continue now. And here's one standard, which was a very characteristic standard in the restructured code. It came along at practically the same time that we finished doing the restructured code, and it was part and parcel of the revisions of the restructured code. This is the no-CLAR standard. This standard became effective in July 2017, and it is a major change in what the code provisions said before about what happens when auditors or professional accountants in business, for that matter, in the course of their duties, in the course of their work, come up with evidence or suspected evidence of serious non-compliance with laws and regulations. That's what no-CLAR means, non-compliance with laws and regulations. The code up until 2016 was very silent about this. The restructured code has now a very clear no-CLAR standard whose direction is auditors, accountants cannot turn a blind eye to non-compliance that they see in the course of their duties, that they encounter in the course of their duties. And the standard describes a process which very briefly I will mention here. You can see it on the slide yourselves. describes a process of the steps that the professional accountant, say the auditor, has to take upon such occurrences. First of all, the standard says that the auditor must establish what are the legal and regulatory obligations in their jurisdictions that they have to comply with. They must know and comply with the local law and regulation. Secondly, if they encounter serious non-compliance or suspected non-compliance, they have to raise the matter with the management or those charged with governance of the entity they're auditing, and they must assess the appropriateness of the response. Thirdly, to determine whether to take further action and what are possibilities for further action. One further action is to disclose the matter to an appropriate authority, public authority. The other is to withdraw from the engagement. The standard essentially says that the auditor has a right to choose depending on factors and circumstances that the standard describes and that I will mention in a moment, as to which course of action to take. But whichever course of action to take, the standard enables the auditor to bypass the principle of confidentiality, which was a barrier to disclosure before. So if the auditor chooses to withdraw from the engagement, the standard says that he or she has an obligation to inform the successor auditor about the reason for the withdrawal. So this will be transferred on to a duty now for the successor auditor. So what is the framework that the standard poses? What guidance does it give to exercise this right to disclose? Clearly, this depends on the nature and extent of the potential or actual harm to stakeholders. There are big non-compliances and small non-compliances. Secondly, it depends on whether there exists an appropriate authority, because we have seen that in many jurisdictions there does not exist an appropriate authority. That can, by appropriate authority, I don't simply mean an authority that has a general jurisdiction over these matters. I mean an authority which can take steps and measures to tackle the non-compliance. It also depends on availability of legal protection for the auditor, because very frequently auditors who have disclosed come under legal threat and liability suits. And finally, we also know that in some jurisdictions, the rule of law is not as strong as it should be, and there may be even threats to the physical safety of auditors. So clearly, all these factors, the standard allows all these factors to be taken into account and asks the auditor to use professional judgment, but the two courses of action are right there. Next one, please. Well, before I go to questions, I must say that we consider this NOCLAR standard as a major step, a major change that has come with the restructured and revised code. And I must tell you that many international organizations, primarily the OECD, but others as well, who work on programs and policies to fight fraud, money laundering, and other such illegalities, have expressed a great deal of interest and have had very serious conversations with us about this standard and its application. They think that this makes the accounting profession a very useful ally in the fight against corruption, malpractices, money laundering, and so forth, and fraud. So this is a time to stop for questions. And Yuri, I'm back to you if there are questions on this or anything previous.
We have questions from Oleg. Do godfathering-based relations may cause any independence threat?
Do what?
Godfathering-based relations.
You mean baptizing another person's child?
Yes.
Well,
You as
I-
Greek will understand why.
you know, I come from Crete, and in Crete, godfathering is a very sacred thing. So I will not answer this question. I'll let Ken address it, and then I'll make a comment. Ken, godfather.
Yeah, certainly well, the code, first of all, doesn't include godfathering as if you will, the inner circle of individuals that the code addresses very specifically. What I mean by inner circle is that the code has those two concepts of an immediate family member or a close family member. The immediate family member essentially would be, the children or the parents of the accountant. And the close family member would be the slightly larger circle of perhaps the brothers or sisters. So the code doesn't specifically go outside of those two inner circles. But having said this, the code does deal with the concept of a close business relationship or a close relationship even. So if there is a possibility of influence or possibility of conflict of interest as a result of the godfathering relationship, then the accountant has to bear that in mind. So there is the concept of a close relationship.
Well, thank you, Ken. I would add that indeed the general principles in the compliance framework essentially include this, although the code does not name godfathering. My personal view, of course, as I said, being Greek and Cretan myself and being the godfather of some good children, is that godfathering has been given a bad name by that movie, The Godfather, and the ethics of godfathering should be a chapter for some of us to work on in countries where this is a habit. But it's not necessarily something you would put in a global code if you can cover it by general principles, and I think we do.
Thank you very much. We have two more questions. One again from Alec. Does non-cooperation with regulatory or oversight bodies can be treated as a violation of the Code of Ethics?
I think that one of the premises of the code, which is right in the beginning of the code, is that under the standard of professional behavior, accountants must be aware and follow all the laws and regulations in the jurisdiction where they operate. So clearly this includes following the regulations. It seems to me that it is a breach of ethical behavior, but also the way I hear it, it may be a breach of law itself before you go to the ethical behavior. I don't know if Ken wants to add something to this. Ken?
No. I mean, I think what you've said, Stavros, kind of makes sense. I mean, at the end of the day, law and regulation have primacy over the Code of Ethics. So the code in any event requires compliance with applicable laws and regulations. It is a fundamental requirement that is a part of the fundamental principles of professional behavior. As part of complying with that principle of professional behavior, all accountants and firms are required to comply with applicable laws and regulations. So, and that features very, very strongly in NOC law. Our standard on NOC law is first and foremost a standard that requires compliance with laws and regulations and responding to instances of non-compliance with laws and regulations.
Thank you, gentlemen. The next question is from Ludmila. What if the country legislation in terms of client confidentiality is not consistent with the Code of Ethics?
Can you repeat that? I'm sorry, I didn't get it.
Yeah, what if the country legislation in terms of client confidentiality is not consistent with the code requirements, with the code?
Okay, I assume that this means that there are some countries which have very strict confidentiality laws. And that is, in fact, the case in some jurisdictions, in Europe too, but not only in Europe. Some countries have very strict confidentiality laws. And as Ken said, one of the premises of the whole code is that if there is a law or regulation in a national jurisdiction that is not in agreement with the code, the primary duty is to follow the law and regulation. Now, however, in this case, if there are very strict laws of confidentiality, this will in fact this will prevent the application of the best part of the no-class standard, which is disclosure of non-compliance. And in those cases, we have asked both professional organizations and regulators in those jurisdictions to see what they can do and how they can influence their legislation to become more consistent with the no-class standard. Certainly, the international organizations like the OECD, in their fight against fraud, black money laundering, and so forth, are in the same direction. Ken, do you want to add something to this?
Yeah, no, that's an important question, and thank you for raising this. I think as Stavros and I mentioned earlier, national law regulation take precedence over the code. So the code cannot override applicable laws and regulations. So if there is a confidentiality or a data privacy law in a particular jurisdiction, that law will prevail. So the code cannot override. So if there is a requirement in the code that compels the accountant or the auditor to report or to disclose information, but there is a legal confidentiality requirement in that jurisdiction, the accountant cannot make that disclosure. And the code allows for that. So the accountant would not be in breach of the code if he or she is prevented because of a confidentiality requirement in law. So that's an important principle that permeates the whole code. It's not just in relation to no-class.
Yes.
Thank you very much. Thanks to audience to asking interesting questions in this and previous sections. And let me encourage to ask more. So, and we can continue with.
Thank you, Yuri. And let me just take the next few slides, and we're going to take a bit of a deeper dive into the independent standards. And Stavros and I will take turns to cover different parts of the code, the international independent standards. We won't have time to cover everything, so we've been quite selective. So I will cover perhaps some of the earlier sections of the code, the independent standards. Stavros will then turn on to the area of fees, and I will close off with non-assurance services. So let me just give you first an overview of the IIS, which is International Independent Standards. As you can see here, Section 400 is the basic foundation of the International Independent Standards. That is the section of the code that contains the essential concepts that apply across all the international independent standards. So concepts like what is a public interest entity? Concepts like what is a related entity? Because as you will appreciate, for those of you who are in the audit field, you will have groups of companies and they have related entities, subsidiaries, associated companies, joint ventures, etc. The code uses the concept of a related entity in addressing those components. Section 400 also deals with the concept of a network firm. You know, what are the characteristics of a network? How do groups of firms, if they come together, if they get associated in some ways, if they share resources, etc., do they constitute a network? Because the independent standards apply to firms and their network firms. So that's a very important principle. Section 400 deals also with other concepts like what is the period during which independence is required, what are the general documentation requirements, and what are some of the essential principles regarding communication with the statutory governance. So, as I say, Section 400 really lays out some fundamental concepts and principles that apply across the IIS. And then we have a series of sections within the IIS that deal with different topic areas or issues, if you will. In this presentation, we'll cover in particular fees, gifts and hospitality, or more broadly inducements, long association of personnel with an audit client, so that's dealing with partner rotation, and finally provision of non-assurance services to an audit client, which is a very significant area. But otherwise, if you do have time, do take a look at the other sections of the code as well. They deal with various issues that can arise in relation to audit independence, especially when dealing with personal interests or personal relationships with the audit client. So as you can see, financial interests, loan and guarantees, business relationships, etc. So let me move on to the section that deals with gifts and hospitality and more specifically inducements. As part of the restructuring of the code and the revision of the code that Stavros mentioned earlier, this is a part of the code that our board made substantive revision. The concept of inducement is very broad. As you can see here on the slide, the different types of inducements. They can be gifts, they can be offers of hospitality, offers of entertainment, political or charitable donations, appeals to friendship and loyalty, employment or commercial opportunities clients can offer the firm, and preferential treatment that is given by the client to the auditor or to the auditor's immediate family, for example. So what the code now requires, what we have done in this section of the code is, first of all, to clarify the appropriate boundaries for the offering or accepting of inducements. So in other words, to make clear when an inducement is acceptable and when it is not acceptable, because not all inducements necessarily are unethical. There are some inducements that can be quite positive in the sense of encouraging, in the sense of promoting good behavior. But yes, there are inducements that incite unethical behavior, and that these are the issues that this section deals with. So there is a bit of a framework in terms of how to think about an inducement. First of all, the auditor is required to identify any inducements that will be in breach of applicable laws and regulations. In many jurisdictions, or in most jurisdictions, there will be laws or regulations dealing with bribery and corruption, for example. And if there are inducements that are inciting the auditor to commit an act of bribery or to be involved in corruption, clearly that will be in breach of the applicable law or regulation. So the code does require the auditor to respond to this and make sure that the issue is addressed, that certainly the auditor doesn't commit any breach of law or regulation. If the particular inducement is not illegal, then the code requires the auditor to assess whether there is intent to improperly influence the behavior of the recipient of the inducement. And what we mean by intent is that there has to be really desire on the part of the offerer of the inducement to influence the behavior of the recipient. Now, the offerer can be both the client or the auditor, because it can work both ways. So the code does address both, and there is a very explicit prohibition to offer or accept any inducement if there is intent to influence behavior. Now, the code does provide a very comprehensive guidance to make that assessment of intent. There is a list of factors, and there is going to be an assessment of the particular inducement. What is the nature of that inducement? Is it part of routine business? Is it given to everybody, or is it given just to the auditor? So there's a number of factors there to evaluate the the degree of intent. And if there is no intent, then there is no prohibition. Then the inducement can be accepted, but there has to be an assessment of the threats that come with that. And if the inducement is trivial and inconsequential, for example, an offer of a cup of coffee or an offer of a lunch, clearly that sort of offer is going to be trivial and inconsequential, and the code is very explicit that in those circumstances there is no threat, and that inducement can be accepted. But if there is intent, if there is an assessment of intent or there is a perception of intent, the inducement or the offer is prohibited, even if it is trivial or inconsequential. If there is no improper intent, as I mentioned, there is a requirement to apply the conceptual framework, which applies throughout the code and throughout the independent standards. Let me just move on to the next section that I'd like to cover here, which is dealing with partner rotation, and that's long association. And our board revised this standard a few years ago now, maybe 3 years ago, and it came into effect around 2017. This was a very substantial revision to the independent standards. It deals with partner rotation. The overarching objective was to create an environment for a more effective fresh look. In other words, to bring a fresh set of eyes to the audit. And our board took a very comprehensive look at the existing requirements for cooling off for partner rotation. And we made very substantial revisions to those cooling off requirements, as you can see here. So previously it was, the regime was a 7-year time on for key audit partners and a 2-year cooling off. Now we've taken a very graduated approach. So for the engagement partner, that is the individual who is closest to the audit client. The time on the engagement remains a maximum of 7 years, but cooling off now has been extended to 5 years. So 5 years to cool off before that individual can come back to the engagement. For the engagement quality reviewer, the cooling off period is 3 years, and for any other key audit partners, it's 2 years, before 2 years. The time on period has not changed, remains 7 years, and the important point to bear in mind about the time on period is that it is to be calculated on a cumulative basis. So it is not consecutive, but it is cumulative, meaning to say that if there are breaks in service, those breaks in service don't count. So if somebody has gone off, for example, for a maternity leave or has been sick for a period of time, that time doesn't count into the computation of the time on period. So what our board has also done is to really strengthen the safeguards or the guardrails around the cooling off period. So if an individual has entered into the cooling off period, that individual is prohibited from doing a number of things, as you can see here. There is a prohibition to provide advice of a technical nature or industry-focused advice to the audit team or to the client, with an exception that it has to be related to matters in the last year of the audit in which the individual was involved. There's a prohibition for the individual to act as a relationship partner. The individual cannot lead or coordinate services to the audit client. The individual is also prohibited from engaging in frequent or significant interactions with senior management or those charged with governance of the client. And the individual also is prohibited from exerting any significant influence on the audit. So that's in a nutshell some of the key changes in our independent standards on addressing long association. The standard does deal with a variety of other issues as well, which I won't go into detail at this point. The final area within section 400 I want to touch on is about breaches. Breaches of independence requirements can arise, as you will appreciate. Sometimes they can be quite inadvertent, but sometimes they can be intentional. And the code does deal with those circumstances. There's a whole framework of how to address the breach of an independence requirement. And from an inspection perspective, that's an important issue. How would an inspector evaluate how the firm has responded to a breach of an independence requirement. The code does set out a framework, as I say. There's a whole thought process. There is a communication process as well with those charged with governance. And there is a requirement to really assess the significance of the breach to make an evaluation, because what the code has been quite careful about is not to cause the firm to resign from the audit simply because of a minor issue, a minor breach that has occurred in a, let's say, far-flung subsidiary, simply because an engagement team member happened to inherit, for example, a share in an audit client. So the code does take a very proportionate approach, evaluate the significance of the breach, determine whether it can be addressed, what action can be put in place, what steps can be taken, communicate as soon as practicable with those charged with governance, give them all the information that they need to make their own independent assessment, engage in dialogue with them, and come to an agreement as to how to address the breach. And at the end of the day, there is a requirement to document how the firm has addressed the breach. So let me pause here and see if there are any questions before we touch on into the two other areas we want to cover in this session.
Thank you, Ken. We have two questions. One is from Ludmila. Just to clarify, are the association requirements applicable to any audit client or PIEs only, public interest entities only?
If I'm understanding correctly, is the question that is there specific requirements that apply to PIEs only?
Let me repeat. Are the association requirements applicable to any audit client or PIEs only?
You mean the
long association? Yes, correct. Yes, and that's a good question. I should have emphasized that the partner rotation requirements apply to PIEs only. That is correct.
Thank you. Another is from Oleg. Can doing public compliments in favor of audit client be considered as advocacy threat?
Yeah. Could you repeat the question again?
Can doing public compliments in favor of an audit client be considered as advocacy threat?
Stavros, if you have a response, please come in. Otherwise, I'm more than happy to respond as well.
Well, I would say that that is a very interesting question, but I would say that it would depend very much on the context and on the content of the public compliment. For example, an auditor can say that a firm is well-functioning because that's, and their financial statements are credible, because that's basically what he says in his audit opinion. I would not think that this is an advocacy threat. He simply repeats what has been said in the audit opinion. If the auditor, however, engages in a compliment that amounts to, say, marketing the projects, the products of his audit client, that, yes, could be advocacy, active advocacy, and would not be allowed under the code. But it depends very much on context and content. So every time that we find something that depends on context and content, which you cannot either totally forbid or totally allow, we have to have factors to exercise judgment. And that's what the code essentially says in many places, that you cannot make a rule out of that, but you have to make judgments about what the context is.
Yeah.
Thank you very much. We have one more from Valery. It's in Russian. Let me translate. Are there any limitations on duration of agreement with the audit client? Well, I guess this is about rotation principles around the globe. Maybe if you can just comment.
Yeah, I'm happy to respond briefly, Stavros. The code doesn't deal with limitations on audit tenure, meaning to say how long the firm can continue to act as auditor of the audit client. There are specific requirements for partner rotation. That is currently how as far as the code is going. The code doesn't currently deal with limitations on audit firm tenure. There's no mandatory firm requirement as you have, for example, in the European Union or in some other jurisdictions.
Thank you very much. No more questions in Q&A, so we can proceed.
Okay, let me turn the floor over to Stavros.
Yeah. Okay. I would like to now talk about the fee-related provisions. There's a whole section in the code about fees. And when we talk about fees, we are talking about the fees that the audit client entity is paying to the auditor for the audit or for non-assurance and non-audit services. That's what fees we're talking about. And of course, this relationship of payer to payee among the client and the audit has created a lot of concerns over time about possible threats of self-interest, possible threats of intimidation, and other items. So this has always been something that especially regulatory stakeholders and our public interest oversight have expressed concerns about. And we have undertaken a project on fee-related provisions, since the code did not have much on this. We started out with fact-finding back in June. We coordinated very much in this work with the IASB, the Audit Standards Board, and we at the same time undertook a project on non-assurance services, which we will talk about in a moment. Ken will talk about that. Now, the final provisions for both the fees and the non-assurance services project were approved just last week. So this is very fresh off the standard setting oven that is coming off. And I would like to just tell you a few words about that. We're hoping that we're going to have the PIOB approval soon, and the effective date planned for this for these provisions on fees and for NAS is December 2022, in a year. Now, first of all, the new provisions of the code on fees do something very basic. They provide guidance on factors to evaluate levels of self-interest and intimidation threats created when the fees for audit or non-audit services are paid by the audit client. This is exactly parallel to what we say in our conceptual framework, that you have to evaluate threats, to identify threats, to evaluate them, and to tackle them, to manage them, to face them. So the revisions emphasize the need to evaluate the level of self-interest and intimidation threats in this case. So the first start of the revision is that it lists a lot of factors. Some of these I'll touch on later, so I won't go through the list, but it leads on factors to guide the judgment on whether such threats exist and whether they are serious. Secondly, the revisions emphasize that it is very important for the audit fee to be a standalone fee. In other words, it is a fee that is charged for the audit services and that is not influenced in any way or combined in any way with the provision and the payment for non-assurance services or non-audit fees. This is very important. This is what we call the standalone principle, because it means that an audit firm should not allow the audit fee to be influenced by provision of other services. And we've noticed that this happens at times in the market, and we are saying that this should not be allowed. However, one exception here is that the pricing of the audit services may take into account cost savings achieved as a result of prior experience derived from provision of either audit or non-audit services other than the audit. So if there are cost savings, there may be an exception there. Ken, let's go. The second important thing is the proportions. Proportion of audit fees versus proportion of non-audit fees. Now, in many jurisdictions, including the European Union, there is a ratio, a threshold ratio. There is a cap as to what is the maximum allowed, the highest possible proportion of audit to non-audit fees. The code has not gone down this route of putting a cap on it. I'll explain our logic. But on the other hand, the code essentially says that the fees charged for the audit engagement and for the review engagement, which are the audit fees, should be clearly separated from the fees paid by the client for provision of services to the client and to related entities, charged by a firm or charged by network firms. So it's not just the audit client and the auditor, it is the audit client and its related entities and the auditor and its network firm. So this distinction is to be maintained. We're not talking about the threshold ratio, but we nevertheless think that this ratio is very important to do the evaluation of threats that are threats to independence. Can we go on? There is another provision of fee dependency. Now, fee dependency is the case where a firm or a network or an office even of a firm have a very high dependence on a single client. And if, of course, you have a very high dependence on a single client, this raises very seriously a self-interest and especially an intimidation threat. Now, here we make a distinction between non-PI audit clients and PI audit clients. For non-PI audit clients, we're giving a signal number, which is 30%, and we say if the fees from an audit client exceed 30% of total fees of the firm, then we should evaluate the level of threats, address these threats if they're not an acceptable level by putting in place appropriate safeguards. If this goes on to a fifth year, for 5 years, without change, then there has to be a determination whether the following actions could be a safeguard, and if so, apply it. Pre-issuance review by a public auditor outside of the firm, or post-issuance review by a public auditor outside of the firm or by professional body. So review by an outsider, which is usually a pretty strong threshold. Now, these are for non-PIs. If we move on to PIs, things become more strict. So if there is fee dependency, that is dependency on a single client, in the first year, if it's observed in 1 year, the threat should be evaluated and it should be addressed if it is not at an acceptable level by appropriate safeguards, which are in the standard. From the second year on, the PI may be subject, the firm doing the audit should determine whether they need, as a safeguard, a pre-issuance review by outsiders, could this be a safeguard? And if so, it should be applied. The important part of this is that if the fee dependency persists for 5 years, at the 5th year, the audit firm has to exit the engagement, unless there is a compelling reason related to the public interest, or a professional body or independent regulator concurs with the continuation. So as you understand, this is a pretty strict requirement because essentially from the 5th year, it requires a separation rotation of the auditor, in fact, which is an instance of rotation that is imposed in this particular case. And this is about exceeding the 15% threshold for 5 years. Now, the most important part, possibly, of the fees, and these are the safeguards we're talking about, and these, to a certain extent, replace the prohibition under a fee cap, over a fee cap, is the communication with those charged with governance. The standard provides that fees for audit of financial statements and the firm's evaluation of level of threats and safeguards applied should be communicated to those charged with governance. It also provides that non-audit fees, the total fees for services other than non-audit charged during the period of the financial statement and applied not only to the audit client, but also to downstream related entities, have to be disclosed to those charged with governance, along with the firm's, again, evaluation of levels of threats and safeguards applied. And finally, that if there exists fee dependency, that should also be disclosed to those in charge, those charged with governance. And finally, the final step, which I personally think, and we think that this is a very important step, probably the most effective step of them all, is public disclosure. We have put in the code now a requirement for firms to ensure public disclosure of fees for the audit, fees for services other than the audit, and the fact of fee dependency, if applicable, namely equivalent public disclosure, disclosure that's equivalent to what is disclosed to those charged with governance. We have in our standard a flexible approach to transparency. We say timely and accessible manner. We don't impose the particular location, for example, the audit report, where this transparency could take place. We also say again in this board, as it is generally true for the code, that auditors and audit firms should comply first with legal and regulatory disclosure requirements that exist in a particular jurisdiction. And if there aren't, that the firm and the auditor should discuss with those charged with governance the benefits of disclosure by the client himself or herself. And finally, to the extent that disclosure is not made by the client, the firm is required to publicly publicly disclose, as I said, in a timely and accessible manner. Let me add something on why we decided not to go to a cap, to a maximum cap type of approach as in the European Union. There are several reasons. One reason is that, of course, a number, a cap, may be managed and mismanaged. People may change names or may change categories of services so as to achieve a cap. So there may be arbitrage around a specific number, which is a cap. We're worried this, especially in the case of a global code. Europe is, of course, a much more compact jurisdiction compared to the globe as a whole. Secondly, as Ken will say in a moment, we have taken a major step in the provisions for non-audit services to essentially prohibit services that give rise to a self-review threat. Now, that is probably a big chunk of the actual services being provided in the market. So a cap might not be a cap of the level of what they have in the European Union, might not be really of any use at all in this case, if there is an actual prohibition and a reduction of services. And the third reason is that, of course, we've been thinking, and this belongs more to the non-audit services area, we've been thinking that a cap is very much associated with what is called the white list or a blacklist of services that should not be provided along with the audit, and which exist in the European regulation and other jurisdictions. We thought that the code should not go down this route because, of course, as technology develops very quickly, there are new services or new forms of services that arise, and just listing services always misses some of the new services and the innovations that are coming down. So for all these reasons, we did not go down the route of having a cut, but we did go down the route of having all these very effective, in our opinion, alternatives. So that's what I had to say about fees. Questions?
Thank you very much. We have a couple questions from Misha. If the copying and pasting some accounting policies and after changing engagement team is a breach of independence, especially when the fee of audit is 3/4 and the fee for non-audit or non-audit services is 1/4, and the client is not PIE, and the total percentage of fee is 0.25% of total firm's income. Should I repeat the question?
Well, yes, it's a bit complicated, and it has too many numbers. I'm sorry. I don't know if my colleague. No, wait. Ken, have you caught the?
Yeah, no, I think it would be helpful to have the question repeated. Yes.
Okay.
Yes. So let me be slow. If the copying and pasting some accounting policies after changing engagement team is a breach of independence, especially when the fee of audit is 3/4 and fee for non-audit services 1/4. The client is not PI and the total percentage of fee is 0.25% of total firm income. I think the question is related to a situation when there is a audit and non-audit services provided to one client, but
so the copying and pasting is a non-audit service. Is that the idea?
Copying and pasting some accounting policies. So I guess here the question is that accounting policies are the policies of the entity, of the audit client, and not the policies of audit firm. So that's for starting point.
Okay, well, let me give an answer, but maybe can supplement what I say. First of all, just copying accounting policies from another entity is not necessarily a bad thing, because we live in a world where some entities are more advanced, and some who come, instead of reinventing the wheel, say in the case of having to go from a national accounting standard to the international accounting standard, if you copy practices from somebody who's more experienced, is not necessarily a bad thing. So far as I'm concerned, I can't understand how it would relate to independence. But maybe my colleague can say more about that.
Yeah, and I'll touch on this in a moment when we cover the topic of non-assurance services, because as part of this new standard on new non-assurance services, we have made some changes to the area of advice and recommendations as part of an audit. So I think there are maybe a couple of principles that have to be taken into account. One is the auditor is not prohibited from providing advice or recommendations to the audit client as part of the audit, as long as the auditor does not assume management responsibility. So that's an important principle. And the second principle, which I'll come on to again, is that as part of providing that advice or recommendation, the auditor does not face a self-review threat. So again, that's a very important thing because the principle is that an auditor should be independent and should make independent assessments of the financial information. and therefore should not be reviewing or reassessing his or her own prior judgments. So as long as those two overarching principles are adhered to, there's no prohibition in the code for the firm to provide advice or recommendations in relation to accounting policies. So to your specific example here, to copy and paste accounting policies from whichever source, that should be okay as long as management assumes full responsibility, because at the end of the day, it should be a decision of the management of the client as to whether they agree that this is the appropriate accounting policy for their enterprise. So the auditor can certainly advise on this, but management should assume full responsibility. Now, in terms of the linkage to the percentage of fee, I'm not sure necessarily there is a direct link there, because unless there is significant or very substantial work involved in providing that advice or recommendation, I would not anticipate the fee to rise to such a level that there would be very significant threats. I mean, clearly, there, as Stavros mentioned, there is a need to bear in mind the level of the fee that's involved, and therefore address the threats that are created, the self-interest threats and intimidation threat. Equally, there is a need to bear in mind the proportion of the fees from the audit client relative to the total fee of the firm. So maybe I'll stop here, Yuri, and see if there's any additional question.
No more questions in the Q&A tab, so we can proceed. Okay, thank you. Okay, so in the remaining time that we have, I just want to spend some time talking about these revised standards now on non-assurance services. This was one of the most substantial projects our board has undertaken in the last few years. It occupied our board time to a very significant extent over the last 2 years. And the context is essentially that over the last few years, there have been very significant changes across jurisdictions around the world. We've seen a shift in public expectations regarding audit independence. Certainly, there's been a number of accounting scandals, auditing scandals, and therefore auditor independence has come to the fore. The other context also is that audit firms have continued to grow as part of multidisciplinary firms. In addition to audit, they provide a variety of other services to their clients, tax services, IT services, consulting services, advisory services, a range of services. And as they do this, there have been concerns from the regulatory community, from the investors, from other stakeholders about the impact of those services on the independence of the auditor. Clearly, the more services are provided to the client, the more the auditor is, if you will, attached to the client, the more there is a possibility of threats being created to the auditor's independence. I mentioned the changes across jurisdictions. We know Europe has introduced changes to the audit regulation. Stavros mentioned the blacklist, new prohibitions and so forth. In the UK as well, recently there have been changes, there have been reviews of the audit and what auditors should be doing in terms of protecting or maintaining their independence. In Australia, we have had similar reviews of the audit profession. Again, with a view to really tightening the independence of the auditor, making sure that they are not really exposing themselves to threats to their independence. So this was a very, very significant project for our board. The objective ultimately was to produce a set of high quality, globally operable independent standards dealing with the provision of non-assurance services. And the issue really was about the permissibility. What would firms be permitted to provide in terms of non-assurance services? And also, there was one of the main motivations was to deal with new services, which Stavros again mentioned earlier,
Firms are now moving into new areas, especially with the advances in technology. Our board really wanted to take a fresh look at those new services and seeing whether they could be addressed. As part of this project, we undertook a series of global roundtables, 4 of them in 2018, across the globe, in North America, in Europe, in Asia, in Oceania. Over 150 senior level representatives across all stakeholder communities that we engage with, regulators, the profession, the corporate governance committee, the investors. So we really collected a lot of very useful input for us to start this project. And I'm pleased to say that our board finally, after 2.5 years of debate, concluded this project just last week, in fact. So we have a revised standard on non-assurance services, and these are going to come into effect for audits beginning December 2022. Audits of financial statements for periods beginning on or after December 15th, 2022 to be quite precise, and subject to PIB approval. So I just want to spend the next few moments perhaps focusing on some of the key changes that we've brought about. First of all, in terms of the structure of the independent standards that deal with non-assurance services. As you can see here, this gives you a sort of overview of the architecture of this of each individual section. We have individual subsections, within non-assurance services that deal with different types of non-assurance services. For example, tax services, valuation services, IT services, internal audit services, etc. And each subsection has this general structure, starting first of all with the general provisions, and then with the specific prohibitions. Now, in the general provisions, we provide as comprehensive as possible set of guidance in terms of factors to help firms evaluate the level of threats that are created in the particular circumstances of the specific non-assurance service. And then we provide examples of actions that can be taken that might be safeguards to deal with the particular threats if they are not at an already acceptable level. Then we move into the specific prohibitions. What is it that firms are not permitted to provide? We deal first of all with the non-PIs, and then we deal with the public interest entities. So that's a bit of the architecture of each non-assurance service section. Now, the most significant change that we have brought about in this revised standard is the self-review threat prohibition. And what this is getting to at the end of the day is to prohibit firms from providing any non-assurance service that might lead them to reevaluate or review prior judgments they might have made in providing that non-assurance service that could have relevance or could be used for purposes of their audit. So that prohibition now is in place, whereas previously it was essentially a threats and safeguards approach. It's an evaluation of the self-review threat. And if the assessment is that the threat is acceptable, the firm could provide that service. Now with that prohibition, as long as there is an assessment that there might be a self-review threat, and the threshold is very low, if it might be created, there's a prohibition. The firm cannot provide the non-assurance service. So that's what it is. So it's this new prohibition there. If there's a self-review threat that might be created, it's prohibited. For PIs, for non-PIs, it's not prohibited, but there is an obligation to assess the level of the threat. So the prohibition only applies to threat. So at the end of the day, what again, to be clear, what the self-review threat is about an assessment as to whether the results of the non-assurance service will form part or affect the accounting records, the internal controls of a financial reporting, or the financial statements themselves. And as part of that audit, the audit team will evaluate or rely on those prior judgments that were part of providing the non-assurance service. And we've provided quite extensive guidance now in terms of evaluating the various types of threats that might arise. Let me turn to the next area, which is about materiality, which has been a perennial concern of the regulatory community and the audit inspection community. Stavros mentioned this earlier. The concern has been that with materiality, it's very subjective. We've heard that concern time and again when we have engaged with the regulatory community. There's a concern that firms might perhaps find ways to circumvent particular requirements or prohibitions in the code if they are made subject to materiality. So what we've done here is tightened up a number of areas where materiality was used as a qualifier previously. So now we have eliminated materiality as a consideration with respect to tax planning and tax advisory services, and also corporate finance services. In each instance, it's when the effectiveness of the advice is going to be dependent on the particular accounting treatment or presentation, and the audit team has doubts about that accounting treatment. So in other words, if the firm is involved in providing that service and there's doubt as to how the outcome of the non-assurance service will affect the financial statements, that service is prohibited regardless of materiality for both tax planning and corporate finance. We've also removed the materiality qualifier for, and that's for PIEs, with regard to acting in an advocacy role in relation to a dispute or litigation before a tribunal or court. So again, that is no longer permitted for PIEs without regard to materiality. But I should have perhaps emphasized in relation to the other two areas for tax planning and corporate finance, the materiality qualifier has been withdrawn for both PIEs and non-PIEs. Whereas for advocacy threats, it is currently permitted for non-PIEs, but subject to assessments of the threats and subject to the advice not having a material effect on the audit. Advice and recommendations, I mentioned this earlier. We have revised this section and made it very clear that first of all, advice and recommendation might give rise to self-review threats. And if that's the case, there will be a prohibition on providing that advice or recommendation, as I mentioned. If for PIEs, if there's no self-review threat, then the non-assurance service or the advice or recommendation is permissible, as long as the firm doesn't assume management responsibility and as long as the firm addresses other threats that might be created. And we've given various examples of advice and recommendation that can be provided during the course of the audit. For example, advice on the proper accounting treatment, advice on the journal entries that can be, that would need to be put through to make adjusting entries as a result of audit findings, for example, or recommendations for improvement in internal control, etc. One of the areas that our board spent quite a lot of time debating is the area of tax advice, and in what circumstances tax advice would not create self-review threats. And really, we've narrowed those circumstances to really three situations in which we are saying, we have said in the code now that providing tax advice or tax planning services will not create a self-review threat. Number one, it is if the particular tax advice or tax planning service is supported by a tax authority or of a precedent. In other words, it's already been accepted by the appropriate authority with this a clear precedent. The second situation is if the tax advice is based on an established practice. In other words, it's become generally accepted practice in the particular jurisdiction. And the third area is, or the third situation is if the advice has a basis in tax law that the firm is confident will likely prevail if it is challenged. So we have really taken a very careful look at those situations, and our board does believe those situations are sufficiently rigorous to limit circumstances in which firms will be permitted to provide tax advice that would not be deemed to create a self-review threat. One of the area also that our board has revised in terms of the particular requirements is acting as an expert witness. There's now a new prohibition on acting as an expert witness in a dispute involving an audit client that is a PI, unless the firm was appointed by a tribunal or court. And we've also clarified the circumstances in which the firm might give evidence to a court or tribunal. In particular, we've made it very clear that there won't be an advocacy threat if the firm is appointed by a court or tribunal. There's also guidance with regard to circumstances where the firm is appointed to act in a class action lawsuit. And class action lawsuits, as you may appreciate, does arise in a number of jurisdictions, and in particular in the United States, it can be quite prevalent. I believe that might be the last area I want to touch on, and that's communication with the discharge governance for PI audit clients. This is one of the significant revisions we have made in the non-assurance services standard. What we've now established is really comprehensive guidance for firms to agree a suitable process of communication and clearance of the particular non-assurance service with those charged with governance of the PI audit client. So that's really for PIs. And the objective of that, establishing that process, is to really pre-agree the approach to really, if you will, having an independent set of eyes coming in and looking at the particular non-assurance service and agreeing whether or not there would be any significant threats to the firm's independence in the provision of that service. So with that process in place, for firms that are intending to provide a non-assurance service for PI audit clients, there is a requirement, first of all, to provide information to those charged with governance to enable them to make an independent assessment as to whether the threats that might be created by the provision of that non-assurance service will be an acceptable level. And if they are not at an acceptable level, that the firm will address those threats. And secondly, to enable those charged with governance to provide their agreement for the firm to go ahead and provide that non-assurance service. So that process deals with that. And in terms of the matters that those charged with governance can consider, the nature and scope of the non-assurance service, and also the basis for the firm's own assessment as to whether the threats to independence are at an acceptable level. Our board spent quite a bit of time dealing with the particular issue of providing a non-assurance service to a holding company or parent company. This was a particular issue that IFIR, the International Forum of Independent Audit Regulators, as well as IESBA had asked our firm to address, because auditors can provide non-assurance services not only to their audit clients, but also to parent entities, the ultimate parent company or even intermediate holding companies. So what we've put in place here is the process, and we've made it very clear that firms can provide services to their parent companies subject to a number of conditions. First of all, that there is a communication that needs to happen. Secondly, that the firm doesn't assume a management responsibility in providing that non-assurance service. Thirdly, if there is going to be a self-reveal threat, the firm doesn't go ahead and provide that service. But importantly, and ultimately, there has to be pre-clearance, if you will, from those charged with governance. They have to agree, first of all, about the firm's assessment of threats to independence, and they also have to agree with the provision of that non-assurance service. So that's an important, if you will, set of safeguards we put in place within the code to really protect the auditor's independence when it comes to providing those non-assurance service engagements. So let me pause here, Yuri. I know this is, quite an important set of changes that we have finalized just last week, and more than welcome any questions that the participants might have before we close the session.
Thank you very much, Ken. We have one question, actually two questions, but another is on materiality benchmark, which I will not ask because it's event on ethics and not materiality and other ISA standards. So from Natalia, we have questions. An auditing company provides a compilation of financial statements to a public interest entity. After that, the same company audits the same financial statements. At the same time, different teams provide compilation and audit services. These teams do not communicate with each other. Is this violation of independence requirements?
That's a very good question. And compilation of financial statements essentially form part of the category of accounting and bookkeeping services. And what our board has now introduced as part of its new standard is that the firm, it doesn't depend on whether it's the audit team itself or it's a different team from the firm that is providing that compilation service. But for PI audit clients, that service will be prohibited if there might be a self-review threat. Let me just pause here. That service will be prohibited because there is an assumed self-review threat that arises. It's not conditional on a self-review threat. There is an exception with regard to provision of that sort of compilation service for subsidiaries, subject to very, very stringent conditions. But otherwise, for purposes of preparing financial statements, compiling financial statements for the audit client, that is prohibited for PI audit clients. It is not prohibited for PI audit clients as long as the compilation is routine or mechanical. In other words, the client should have prepared the trial balance. The client should have approved all the entries, all the accounting entries that support the financial information that will go into the financial statements. But otherwise, for PI audit clients, as I said, this will be prohibited.
Thank you very much. I know that you need to switch to another just very shortly. Let me ask Ms. Natalia Konovalenko, the representative of the WorldBank, our major sponsor, along with EU, to make final remarks here.
Thank you very much, Yuri. Thank you very much, colleagues and our honored speakers for this deep dive into IESBA Code. And let me to greet you on behalf of the WorldBank team implementing this tariff regional program. And this tariff abbreviation stands for the Strengthening Audit and Reporting in Countries of Eastern Partnership. And it is a regional program aimed at creating a transparent policy environment and effective institutional framework for corporate reporting within the countries that make up the EU's Eastern Partnership. And these countries include Armenia, Azerbaijan, Belarus, Georgia, Moldova, and Ukraine. And thanks to Yuri, thanks to Twinning Project, to Panas and Dimitra, colleagues, our key stakeholders from all these 6 countries are present today at this event organized for SARAS, first of all. And thank you, Yuri, for inviting us. So this program is being implemented since 12-13. And all 6 countries have made significant progress in modernizing their systems of corporate financial reporting since the program inception. And during these years, we learned a lot from each other and from each other's experience in addressing common outstanding challenges and issues in financial reporting, accounting, and audit regulation and supervision frameworks in our countries. And we continue to do so as the program is now extended for 2 more years, for 21-22 years. So for 2021 and 2022. So we have more to go and more to achieve, and perhaps with special focus on building the trust, as Yuri highlighted at the very beginning of this meeting, that all audit profession is about trust. So a trust to the profession, trust to the legal and regulatory environment and framework, compliance with international standards and good practices. And in this regard, joining this event today was really very helpful in getting better view of IESBA Code and international dependent standards from the first hand from our honored speakers today. And thank you very much for this opportunity once again to Stavros, to Ken. Thank you very much to Twinning Project, Panos, Dimitra, and of course to SARAS and to Yuri on behalf of all the startup countries involved in today's event. Thank you very much.
Thank you, Natalie. Stavros, Ken, it was a big pleasure and very interesting. And we hope that we will join once again, and maybe physically. Thank you again.
Well, I want to thank you all very much. Thank you, Natalia. Thank you, Yuri. Thank you, Panos, and all the organizers and all the participants. As you heard, you were the first recipients of our most recent innovations in the code, like prohibitions of self-review threat cases, like transparency of fees, like communication with those charged with governance. These are big innovations in the code, and you are the first recipients of this. We will be doing a lot of outreach over the coming year about these new items. I hope this was helpful. We will be happy to answer any further questions you may have. Please send them over to us. And we will also be happy to meet you again at some other forum, hopefully in person and not just electronically. So our best wishes for the holidays and for a good new year. Thank you all very much.
Thank you. Thank you very much.
Thank you very much.
Wishes.
Thank you, Yuri, and
Thank all
I see John there as well. Hi, John.
John.
Hi.
Thank you again, everybody.
Participants from
Goodbye.
Goodbye.
Thank you very much. Thank you, Ken. Thank you, Mr. Peter. Thank you, all participants. Thanks.
So, unfortunately,
Bye.
there was one question pending, but as we promised, we will communicate it further.
Yuri, you're not heard. You're not heard, Yuri.
I heard him. I heard him.
I'm sorry. I didn't.
So, but yeah, we are running out of time, we know, so thank you very much.
Yes.
Okay, Yuri and Natalie, just a closing remarks on behalf of Europe. We will let you know that we are very close to you. We're very close to reforms to all these countries, Natalie, you mentioned before, and we'll help you to build trust to society and to investors. That's our willingness. Thank you so much.
Thank you.
Indeed.
Thank you, Panos.
Thank you.
Panos.
Bye-bye, everybody.
Bye.
Greetings to all.